Hi everyone, this is Ben with It's All in the Reflexes. You can find me on Substack at ben1148x2 .substack.com, or find me on Twitter, X. I post there frequently, just quick chart updates and things. And if you're interested in seeing things more real time, try to put out the Substack once a week, once every other week, depending on other things that I have going on. So this is the third video today that I wanted to cover a signal that I see on the VIX that doesn't come up very often, and how that might impact our outlook on the near-term trend for the S&P. So taking a look at VIX, this is a concept called backwardation, and there are two terms with VIX that sound more complex than they are. There's contango and backwardation. And so the VIX is a futures contract. Futures contracts have a declining value as they get closer to contract maturity, and that's called the rate of decay. And so as we approach, a VIX is a 30-day. When we refer to the VIX, it's generally the 30-day VIX, and so an aggregate of contracts that are set to expire within 30 days, and their value is constantly declining as we get closer to the 30-day mark, whereas longer duration VIX is further away from its contract date and has not entered the same accelerated rate of decay. So we would expect, based on rate of decay alone, longer duration VIX contracts to have higher value than shorter duration VIX contracts. In cases where short duration VIX is of higher value than long duration VIX, it's telling us that the market believes there to be more volatility present at a premium futures contract rate in the current environment than in the future, and that tends to occur near more material market volatility and in proximity to a low. So the good news is we see it in proximity to a low. The bad news is that there can be more downside to come before we achieve that low. So this is a higher time frame chart. I'm looking at a 3-week chart, and we're going to look at instances of VIX backwardation in two ways. We're going to take a look at the VIX divided by the 6-month VIX on a 3-week chart, and then at the bottom we're going to look at the VIX divided by the 3-month VIX to identify signals as well. And then in the middle we have the S&P. There's two moving averages that I'm using. There's a 325-day moving average and 174-day moving average. These align to cycle lengths, and it's using the actual duration and not the timeline of the chart. Let's go back to we'll start with the data as of 2010, and we've got a Bollinger Band applied to this calculation of current versus longer dated VIX. On the 6-month is at the top and the 3-month is at the bottom. So the 6-month is the signal that I'm most interested in, and I'm looking to see if we also experience it in the 3-month VIX as well. But the break above the Bollinger Band, this is like when we do a trend following system, a break above the Bollinger Band would generally tell us that we're going to see some type of continuation. And in this case, even though the VIX rolls back down, that tells us we've had some type of volatility spike. And so we've got the April 19th in 2010, we've got this 3-week VIX divided by VIX 6 months breaking above the Bollinger Band. And then we have further continuation downward over the course of, this is April, and then it concludes in August. So we've got 4 months of downtrend before we take a bounce off of the 325-day moving average and start an uptrend again. This is confirmed when we have we've got the higher, the shorter duration 3-month VIX in backwardation with the VIX as well in a breakout, and then this happens again in July of 2011, and so these are isolated. You've got a much larger breakout here, and that one exhausts by October, so you've got like a 3-month drawdown, and so let's see how it looks small because of how squeezed in the real estate on the chart is, but yeah, it's about a 20% drawdown. So this is meets that like media definition of a bear market type of drawdown in the 20% range. This one back here was 17%. So this signals, even on a 3-week basis, we're reacting, let's say at at the conclusion of it, right? We've already experienced a 10 to 11% drawdown, but it continues further down to 17%. So it's warning us there could be more to come. When you have them in close proximity to one another, that could present some more risk as well. So in this case, you've got these ones are more than a year apart, so about 15 months apart. These ones are only 6 months apart, and we don't have very significant drawdowns after these two. So you've got your low after this one breaks high, after the backwardation on the VIX versus VIX 6-month has a Bollinger Band breakout. Your backwardation takes you from S&P closing at an S&P close around 1790 to a low the next month about 1740. So you're pretty close to the low when this one signals, and again in July, and then you continue for a new high. We've got this larger spike above the Bollinger Band. So this is telling us these ones that are just barely getting above the Bollinger Band did not lead to as sustained of a drawdown as these larger ones in 2010, 2011, and then the one in 2015, which you've got a large spike on the 3-month and a large spike on the 6-month, and then we conclude lower in a 2-wave movement. And then again in 2018, you've got two of them that are almost a year apart, and the first one is larger, more material. I actually get the larger drawdown in the middle. This one in December of 2018 happens in the middle of the drawdown, is where we get the volatility spike. So this large initial one leads to an immediate move, and then we're already kind of in proximity to a top throughout that year. And then of course, the COVID one happens in isolation, and we don't have much time to respond. And then we've got two in at the end of 2022, or end of 2021, and then the beginning of 2022. These precede the larger drawdown after the change in monetary policy with the Fed. And then we had one in August with the summer drawdown in 2024, and now we've had our largest spike above the Bollinger Band in, this backwardation is currently at its highest level since the beginning of 2022 on the 6-month, and the highest level since near the beginning of 2020 on the 3-month. So that's a pretty large shift in volatility and market sentiment, and it would be prudent to expect that to lead to a bit more volatility. Looking at it on a daily, these breakouts can be a bit more frequent when we get into the lower time frame, But seeing them occur as we're losing moving averages, you can see this is again we said 174 is a cycle number for the S&P, and you can see that it does have interest in the 174. Finds it as support in the August drawdown, but it's clearly falling below that now. And it's doing so as we've made a volatility low into a volatility breakout. So that's backwardation. The normal state for the VIX is for it to be in contango, which means that your most recent contracts for the VIX are losing value faster than your long term. So the way that this would resolve is either the near term VIX falls back to a low, or the contract the values for the longer duration VIX start to rise to meet the short term, and that means that we've got both a near term and long term expectation of high volatility. That would be highly unfavorable. The more preferred outcome for us would be to see the shorter duration VIX start to fall. So we'll keep an eye on this. This follows with some of our other market timing signals, though, and tells us that this is likely a move that leads to further downside before we see a bounce into a position of strength. So keep your eyes peeled, and I'll share any questions that you have with me, any feedback, and I'll be happy to share updates as I see them.